A couple questions this morning. First one, Happy New Year, Keith. Why isn't...
Did a customer actually say that?
Yeah, of course.
They're being nice.
Absolutely.
Thank you.
Why isn't trend of 2018 on the SPX resistance in today's range?
Why? Because again, the immediate term range is not the intermediate term trend. So for those of you who've been with me for a while, we have three durations when we look at multi-factor and multi-duration risk management. Multi-duration being immediate term, intermediate term, and long term. So when you look at the intermediate term signal of 2018, that's broken. But I'm going to give you the immediate term range. So the immediate term range is not the intermediate term signal level. So again, if that makes sense, it's just two different durations that you're talking about when you ask the question.
Gotcha. And then lastly, you mentioned this morning that the Fed is likely to get dovish in the face of disinflation and slowing global growth, which would support Treasury bonds. Do you think this will also weigh on the U.S. dollar, or will Draghi and Kuroda be even more dovish in response to those same signals?
Well, this is the fair fight. I think. I mean, if you go back and you said to yourself objectively in the last 6 months, what happened for the three main currency players? I mean, in the currency war, which are the Europeans, the Japanese, and the Americans. The Europeans and the Japanese have completely gone AWOL on this whole policy, and they will continue to. Mario Draghi, unless he has a plan to go work for Goldman again, has literally no plan other than to devalue the euro. I think everybody knows that. So that force is very powerful, and it's going to be uniquely powerful ahead of the January the 22nd, which is the ECB meeting. And then the Japanese, by the way, come back from vacay and are all upset about the movie Unbroken, and they're going to say, hey, look, we got to devalue quickly too. So I think that's what the number one thing that keeps the dollar up is that. The number two thing, which I would not underestimate, is that there are a lot of navel gazers out there who think that we have a 5% US GDP growth environment. So what's going to happen, I think, and that's the US dollar point that really could surprise people within the next 3 weeks, is that you get the US data, again, all the December data from ISMs to PMIs slowed. You'll get the Q4 GDP number at the end of January. That'll slow. And then the Fed's going to be looking at rising jobless claims, and if the jobs report's bad on Friday, then the Fed is going to have to say something about that, like the data slowed. Again, they'd have to just tell you what you already know. And that's when the dollar, I think, in that moment, that's when the dollar will go from overbought to having a big down day.